Hello everyone, my name is Give Moma Guju and I welcome you to yet another valuation tutorial. So this time around we have gone global. So today we are going to look at Meta. So we will be building the valuation model for Meta step by step together. So without wasting time, let's dive right into it. So as you can see here, this is the completed Meta valuation model that I built. So here I projected the consolidated income statement from revenue down to EBIT. So EBIT just stands for operating profit. That's income from operations. And I also projected non-cash items such as depreciation and amortization in the cash flow statement. I also projected changes in working capital, and I also projected CapEx. And we have got historical information. We have got 3 years consolidated income statement from 2021-2023, as well as the cash flow statement and 2-year balance sheet from 2022 to 2023. So if you look at just under non-current liabilities in the balance sheet, you will see a line item named long-term debt. So that should tell you that you need to estimate unlevered free cash flow or free cash flow to the firm. These are cash flows which are available to both equity holders and other providers of capital such as lenders. And the formula being, we start with EBIT, we net out taxes, we add back depreciation, and we subtract changes in working capital. We also subtract capital expenditure. So that's why you've seen me projecting the income statement down to EBIT, and also the tax rate and these other non-cash items and changes in working capital and CapEx. So this is essentially what we are going to do. So now let's look at the template that we are going to use. So here is the template. So first of all, we need to work on the historicals. So we will start by computing the year-on-year revenue growth rate. So to do that, we select the revenue for 2022, we divide it by revenue for 2021 minus 1. And then we copy that to the right. And now all we need to do is we have to express all these other line items as a percentage of revenue. And here we have got cost of sales. These are costs which are directly attributable to revenue. And you can see that this figure here is different with this figure here. This is essentially because I removed depreciation expense from the cost of revenue and put it down here. So that's the reason why here it's the figures are quite small. So if you come to the annual report for Meta, you will see that here. Let me just do a quick word search. So I will just click next. So you can see this is depreciation. We are seeing it in the cash flow statement. But here, this line item, this statement here tells us tells us that depreciation expense is housed inside the cost of revenue expense. So it's saying our cost of revenue consists of expenses associated with the delivery and distribution of our products. These mainly include expenses related to the operation of our data centers and technical infrastructures, depreciation expense from servers, network infrastructure, and buildings. Okay. And if we press that, you will see that here we have got servers and networks, buildings, equipment, and stuff. So that's why I removed depreciation from cost of revenue and put it down here. Now let's put that as a percentage of revenue. Okay, and let's just compute gross profit, which is the gross profit margin, which is the portion of revenue after we have removed cost of sales. And let me express that as a percentage of revenue. Let me express that as a percentage of revenue. Let me express that as a percentage of revenue. So you can see that research and development is taking much in terms of the percentage of revenue, because Meta is a technology company, and obviously it heavily invests in research and development. Okay, and with the emergence of new technologies such as AI, obviously it has to stay on top of the game. So it has to invest heavily in that. So we've got EBITDA margin, which is a portion of revenue left after we have removed operating expenses, right? And it's also income from operations before accounting for the aging of assets and equipment. So here, let's just divide that by revenue, okay? And let's divide that by revenue as well. Let's compute the EBIT margin, which is earnings before interest and tax. Let's compute the historical tax rate. So we take the provisional income tax, we divide it by earnings before tax, and then we copy that to the right. Now let's copy the assumptions from the completed model. So let's paste that. Let's come down here, copy that. Let's copy these assumptions. Let's paste that. Let me copy that and paste here. And let me paste here. So let us quickly project our consolidated income statement. So we select revenue for 2023 and right, and then we copy that to the right, and then we multiply that by 2024 revenue. Then we just copy these formulas here, and let us quickly audit that. Sorry. So let's press F. So that's okay. And let us project our research and development expense based on revenue. Right, and then let's also project marketing and sales. Let us also copy that to the right. Let's copy that to the right. Perfect. So we are done with our consolidated income statement. Now let's proceed to the here. So we just link our depreciation here. Then we copy that. And then here we take the minimum. So we are being a little bit conservative here. So we just assume that is going to remain constant. These figures are just volatile. So we just we just make them repeat themselves. So here we've got changes in current assets and liabilities. So for now, let us project capex. So here we divide that by revenue. Right, and then let's look for information in the annual report that has to do with So I think if we can do this, let me just quickly. Okay, so depreciation, capital expenditure. Okay, let's just wait a little bit. It's still running through the whole document here. So I think we can also say capital. So I think we can also type capital expenditure. Okay. Let's keep on pressing. Okay. So here they are saying we anticipate making capital expenditures of approximately 30 to 37 billion in 2024. Okay. So our estimates here, they have to show a range of the capex figure between 30 and 37. Okay. So let's just copy the assumptions. So let's come here and let's copy these assumptions here. So let's project. Okay, so we multiply that by revenue. Okay, so now we are done. We need to project changes in working capital. So I pulled these figures from the balance sheet here. Okay, so to project accounts receivable, say average, we take the average of these figures here, we divide by revenue for 2023, then we multiply by 360, then we get 40. We do the same here, take an average, we divide by all expenses. So here we come. Okay, so let me just sum for it. So this is, we take a sum of all expenses in 2023. Okay, so here we take this and then we close. Okay. Okay, so I think I didn't multiply by 360. So I multiply by 360 and then average. On this one, I think we are not taking an average. So what we are essentially doing is we are dividing this by revenue, right? This one we divided by revenue because it's not clear in the annual report, so we just found a way to project that. And then here we've got average, so divided by cost of sales, cost of revenue for 2023, then multiplied by, then we get 120. Then here we take as a percentage of revenue, we copy that down. And what else do we have to do here? We have to take an average here of these balances. We divide by sum of the expenses for 2023, and we select that, then we multiply by 360, and then we divide this by revenue, and then we copy that to the right. Okay, so basically if you look here, you will see that we've got changes in other assets. Okay, and we've got also what do you call it, changes in other liabilities like this. So if you come here, you will find that in the balance sheet under current assets we don't have that. Okay, we only have we have got accrued expenses and other liabilities. Okay, we've got partners and stuff. Okay, that's fine. And we've got other assets and stuff. Okay, so so if we come here, you will see that we took this. Where did I take this? So this is 6583. Okay, it's other assets. So we've got accounts receivable, prepaid expenses here, and here we've got non-marketable securities. And so I'm wondering where I got that. I'm actually wondering where I got the other assets figure. Where did I get that? Okay, so other assets 6794. 6794. Where is it? Let me just Control F. 6794. Do we have that figure? Seems we don't have that figure. And what else for? So these are unusual items here. So we've got other assets. What else? What another unusual item? Other liabilities. Where did I get this figure here? 88.84. Where did I get that? Okay, so other liabilities. Let me just take a look. Do we have other liabilities? Okay, we've got accrued expenses and other current liabilities, which means it's already inside there, right? And prepaid and other current assets, which means it's already catered for. Okay, so I think there was an error there. I'm not quite sure why I did that. So let me just do other assets. Maybe I got that from the annual report. Okay, this is it. What happened? So I think I made an error when I was doing that. So let me just cross check my figures there. What was the balancing figure here? So this is goodwill 20. Let me just cross check here. 20 something. Yeah, so I think I made a very big error there. Okay, so let me just say other assets. I think that was a very, so here start by 6583, 6794. So it brings down to 229623. What changed there? Let me just 59,549 and 85,3. So I think the error is here. Okay. Where is that? 3793, 16169, 23,541, 41. What could be the error here? Because I'm seeing that we have got these are total current assets, right? So the other figure is correct, but this one is not correct. So we've got 3793, then we've got 16169, then we've got 23,541, then we've got 41,862. Okay, so 41,862. think that's where the error was. And then under non-current liabilities, we have got other liabilities. So we've got 7764 and 884, like this. Okay, so here we need to redo our formula, then like that. Okay, so now I think our balance is okay. So that was completely an oversight there. Okay, so now so we've got so here they are showing in the cash flow statement. If you scroll up there, you will see that here they are putting other liabilities. Okay, they've also put other changes in other assets. Okay, so in our balance sheet we've got other assets, and we also have got other liabilities. So I'm not quite sure why they included that, because these are under non-current liabilities, they are not short term. For some reason it's a bit misleading, but for the sake of this, let's just work with what we have and then tweak when we are done. Okay, so here let's just copy the assumptions from the completed model. Okay, so here we can just paste that, and here we can just paste that. Right, and we can also paste that. We can also paste that. We can also paste that. Okay, so now let's project that. So here we are going to say this divided by 360 multiplied by revenue for 2024. Okay, and then we copy that to the right. We do the same here. We divide it by 360 multiplied by the sum of the expenses. Okay, so here we take the sum of the expenses, and then we copy that to the right. And other assets, we are multiplying that by revenue. Right, because we are not quite sure, but we are going to do a digging. Like if we come here and try to find out, so we are being told that we classify certain restricted cash balances consisting primarily of cash related insurance policies within prepaid expenses and other current assets and other assets on our consolidated based on the expected duration what. So it's not quite clear. Okay, so we will tweak that, we will change that. Let's just for now focus on completing the model, and then we can do extensive research. Then we multiply that by cost here, cost of revenue, and then here we multiply that by revenue, and then we divide that by 360 multiplied by sum of the expenses. Right, sum of the expenses, and then we take here, and then we take here, and then we do this, and then we copy that right through, and here we multiply that by revenue. Okay, and then we copy that to the right, just that, and then we copy that as well, just like that. Perfect. So now we are done. We are done with projecting these line items. Now we need to link them. We need to link changes, these line items that we've just projected into that schedule for changes in working capital that's in the just under cash flow statement. Okay, so it stopped, it listened to me. Okay, so here I have to compute the operating working capital, and then let me compute the change. So the change, we are taking the 2024 balance, we subtract the 2022, the 2023, and then we copy that to the right. So now I'm not pressing Control Save because it's gonna freeze like hell. And here we need to link that. So I'm gonna link that minus this, and then I copy that to the right. All current assets you link the way I'm doing. So prepaid expenses minus this, right? Changes in other assets, you link the way I am doing. Other assets minus this, and then changes in accounts payable, right? So accounts payable, so we just what's that? Is it accounts payable or changes in partners payable? Okay, that's partners payable, so we copy that. Changes in accrued, so we link that, and lastly we link these liabilities there. Okay, right, and then we can copy that right through. So I think that will look different from the completed model. Okay, let me just so I think this is quite the same. Okay, so yeah, so I think that's it now. So yeah, so I think we are now done projecting these items. So we now need to work on the discount rate. Okay, so this discount rate here, I think, let me go over here. So I've used the US 10-year Treasury, US 10-year Treasury bill rate, okay, is a treasury rate. So here, just a simple Google search, it's saying today that rate is around 4.27, okay, the 10-year US Treasury bill rate. So you can see here, as of the 10-year Treasury was, okay, that's 2021 March, okay, which is fine. And then as for the beta, I just took that from Yahoo Finance. So I took that from Yahoo Finance. Okay, so Yahoo Finance has got a beta 5-year monthly beta of 1.21, which is above the market. So the stock is a bit volatile, It's volatile, in fact. And then so 4. This one should be 4.27, not 21. So 1.21, that's the beta. Then the equity risk premium. My machine is not friendly. It's not friendly today. So now let me. So the equity risk premium, I got it from this website. That's managed by Asweth Damodaran. So I took the equity risk premium for the USA. Okay. So where is USA? So that's USA. So it's around 4.6. Okay. So that's 4.6 there. Okay. So the cost of equity now will be that this multiplied by this. So that's the cost of equity there. And then long-term debt. Long-term debt, we are going to take 2023 long-term debt, which is this one. Okay. And then book value of equity, we're going to take this here. And then we have to get the totals. And then let's get the debt weight. So the debt weight and the equity weight. Okay. So here we have got the tax rate, 17%. We have got cost of debt, which is about 3.6. So that one, I also did a historical computation here. Interest expense, it's around long-term debt interest rate, it's around 3%. So it's around 3%. So and we've got some maturities in the here. So here I can just search interest rate. We have got some ranges here, right? So from 3.63 to 5.79. So this date here, it's going to mature in 2027, and the effective interest rate is 3.63%. And here we are told that interest expense net of capitalized interest recognized on the date was 420,160. So I computed separately that. So the 3.6 might be including capitalized interest. So 420,160, you can find it here. Where can you find it? Is this the correct? Okay, so this is not the correct. Okay, so you can find it here. That's 3% for long-term debt only. So here I'm tempted to put that at 0 there. Okay, and perfect. So now WACC, when computing WACC, what we are doing is we are taking the cost of equity. Okay, so let me just put that in bracket. So we are taking the cost of equity, multiplying it by the debt weight, the equity weight, right? So I think that's a mistake there. The equity weight plus we take the after-tax cost of debt, we multiply it by the debt weight. So we get 9% is the WACC, the discount rate. Okay. So now it's time to link our EBIT. So we now link our EBIT. So let's go all the way to the top. So we're going to link our 2024 EBIT there, and then we copy that to the right. And we are also going to link, we are not going to link, by the way, on this one. What we are going to do is we are going to multiply this by the tax rate. Okay. So then we copy that to the right. In fact, it has to be like this. Okay, perfect. And then we link through our depreciation, right, from the income, from the cash flow statement. Then we copy that through. Then we also link share-based compensation that we've just projected there. And then we can link other. Okay. So by the way, you have to go like 5 years and look if the share-based compensation was a recurrent, if it was a recurring line item in the cash flow statement, even the other. And then we've got the changes in working capital. So here we are just going to link this change here. Okay, so we're going to link this change, and then we are also going to link capex. So obviously we have capex here, capex, right? So I think then we can sum that up. Okay, perfect. So now we have summed up that, and changes in working capital, we've linked it through. What else? So here we have to say 1 plus, then we copy that, right? Perfect. So now here we have to link the 2028 cash flow, and then we have to discount our cash flows here. So 1 plus, we anchor that to the power 1. Okay, so we compute the sum of what we've just done there. So here let's just compute the terminal value. So multiply it by 1 plus this divided by WACC minus 3. Okay, and then we discount that by 1 plus WACC, then we anchor that to the power 5. Okay, and now we compute the total enterprise value. So that will be this, and total debt, let's look for total 2023 debt there. So total debt, right? So total debt, we're going to take long-term debt, and we're also going to take long-term operating lease expense, and we're also going to take this. Okay, so that's total, and then cash and cash equivalents for 2023. So net debt, so net debt, this is simply this. Okay, and then this, and then we link here. So let's just take the diluted one. Okay, like that. So number of outstanding ordinary shares, let's just take the basic here. So here we are saying that this is now our estimated equity value per share, which is now the intrinsic value per share. Okay, intrinsic value per share. So Excel is at it again. It is not responding to our request. So let's choose currency there and current share price. So we can go here, it meta platforms. So we are seeing that this is the current share price there. Okay, 507.76, 507.76. Right, let's turn that into currency there. So here we can just say this. No. So we say this divided by this minus 1. Okay. Okay, and then margin of safety, we say this minus this divided by this. Okay. Is that true? I think I missed somewhere. So I said this minus this, right, divided by this. Okay, which is fine. And on this one I said this divided by this minus 1. Okay, so it's still fine, right? So basically now we see that the share is still is undervalued, right? And yeah, so basically that's how you can project, you can estimate the intrinsic value of a listed company, right? So yeah, so this is it, guys, and I hope you've learned 1 or 2, 3 things there. So let's just say, let's try to, from a model, let's try to remove okay, let me just, what really do I need to do here? Okay, so I think that's fine. I think these ones, they're okay, they're fine, they are very fine. So what I wanted to do was, if we were to put some zeros here, okay, just want to see the effect on all that we, okay, so I'll leave that as is, and then on this one, other assets, I just want to see the result here. So it goes down to 514.87. Still, it's still showing that the stock is undervalued. So that doesn't make much of a difference anyway in terms of you know, the intrinsic value or making the decision to whether buy or sell. Okay, so I think that's it. And so if you've got any comments, any questions, let me know in the comment section below. And just one more thing before we close, we've got this, I've got this page open here, and actually I've got 2 pages open. So now that you are done with your model, you can go and look for analyst estimates, okay, on Yahoo Finance, so that you can come back and compare with yours and even tweak and change your assumptions and matching them with analyst assumptions. So let's just wait a little bit there and see what we have to do. And my network is acting up today. I'm not sure what's happening. You know, the machine, sometimes it's acting slow, the Wi-Fi is not working. I'm not sure what it is. I'm not really sure. Let's just wait a little bit. I think the page will open soon. I think it's taking long. It's taking very long to open. Okay, let's open this page here. So this is value investing, right? So value investing, it's saying Meta Facebook WACC, weighted average cost of capital. They estimated the WACC of Meta Platforms Inc. to be 9.7%, though we used 9%. So now it depends whether you trust these guys. If you trust their estimate, then you can use the 9.7. Then the cost of equity of Meta Platforms is 9.8. We got 10%. We are still near to them. The cost of debt of Meta Platforms is 4.3%. They are saying that's the cost of debt. That's 4.3%. Okay. And when we did our math, we got 3%. But that didn't change. That doesn't have much of a significant change anyway. And long-term bond rate, equity market risk premium, they got that from Damodaran, right? So that's a sort of a scenario analysis. So you can actually take a look here. So let's take a look at their what you call maybe valuation summary. Okay, valuation summary. They are saying the range of the intrinsic value is this. Okay, that's their range. That's the range of the intrinsic value is 251 and this. So that's so what they're saying, actually they're saying the stock is overvalued. Okay, so here they're saying the intrinsic value of Meta is 3. This Meta valuation is based on the model growth exit 5 here with the current market price of this. The upside is negative point something like this. Okay, so like I said, you can then go and change this. Okay, we can go and change, like here they are saying the cost of debt 4.3%. maybe there's something that we got wrong there, so we need, you may, if you trust the assumptions, then you may need to go and do that. So long-term growth rate, we put 3%. We are within range. We are within range. So, and then WACC, the discount rate 8 to 10%. We are still within range. And then revenue estimates. So that's 2023. They put this. So we were a bit aggressive with our projections, I tell you, very aggressive. So you can actually see here, and like here, let's just go back to our model. So now we have got a basis. So our revenue, so I think they got that. Let's try to compute CAG. Okay, CAG. Okay, so the CAG for, I mean the 3-year CAG, right? So what we can do is we can take this, we divide it by this, right? Then 1/3 minus 1. So let's just do that. So that gives us 5%. Okay, so we can change that. So they were right. So we can say, okay, so we can give them, we can say, okay, it's growing. Let's take the assumptions. So 12%, then 13%, 11%. So these are now analyst estimates, right? Let's look at cost of goods. So theirs, they didn't do the way we did. So they just computed everything there and there, something like that. But that's not a problem. So we are saying here at I think that makes sense. We can leave that as is, and then research and development expenses. They put 27 throughout, where they were a bit aggressive, not aggressive as well, but conservative. So we can just adjust ours to so we can copy that to 25, and then here net interest and other expenses, SG 17, SG, okay, so I think they included selling and general expenses there, but I think that's okay, that's fine, and I think we are within range, right? Because even we are not that lost. So here I think we can just take 8% throughout, and here a bit of 9% throughout, right? And maybe within the range of, so here we can say 13, maybe and 10 or 11, right? Which is not bad, by the way. Okay, so here I think we can just take throughout, which is fine. Okay, so we said research and development. They took 27 throughout, so we can just put there, and I think that's okay. And we can come back here and see what's happening here. So now we are at 312, so their intrinsic value is 328, so we are very far much below there, which is not bad, by the way, because they are saying the upside potential is about 35.2%, and we are at 38.4%. So I think we are still within range, and we are still fine, and we are confirming with analysts that the stock is overvalued, right? So I think that's what you can do, you know, with these projections. We are not saying that these guys are the best or their projections are, but because they've been in the game for a while, they may be covering a meta for a while, and they might be they may understand meta very well than you do or than I do. And even the capex, they just put 20% throughout, you see. So it just depends with how you see a business. It doesn't mean that these guys they are the best or they are correct. Sometimes they may be wrong. Okay, and depreciation, they used their own methodology, and we just used the simple one because we just wanted to just quickly get it done over with. And then receivables, so here they were only concerned with inventory and trade payables and trade receivable. It doesn't matter the way we did it, it's still okay. So it's still fine, and that's why I went on to put a 0 there. And then we've got the terminal value here. So I think the fair price 329, outstanding shares, I think we which is fine. I'm not, that's okay. So that's fine, and I hope you've enjoyed it. Thank you for watching, and don't forget to subscribe and share with your peers.